everybody, Jim and Chris here. A lot going on in the stock market, as I'm sure most of you have seen, as a result of the tariffs that just recently went into effect. So a lot to talk about today. We thought, obviously, being the real estate guys that we are, that you all would want to hear how we feel like this may impact either negatively or positively the real estate market over the coming years or months. Being that I'm always a glass half full sort of guy, I took the positive side of the coin. So Jim here got the negatives. So Jim, what sort of potential negatives do you think we're going to see from all this shakeout going on right now?
Yeah, I mean, the theme of the first quarter of this year is tariffs. Nothing has gotten more attention than tariffs. And so this really has just consumed people's minds and attention, and obviously the markets as well. And tariffs can have definitely some different effects. And talking about the negatives, one of the negative effects is, what we're seeing in this drop in the stock market. And when the stock market drops like it has, that's going to cause fear and uncertainty. It's going to affect, or it could affect, consumer sentiment. People might be thinking about making a life change that gets held back on because they are also concerned with another thing that could happen, and that's unemployment. Unemployment could have a rising effect from these tariffs. Again, fear and uncertainty can cause these things. So we have to keep an eye on that for sure. And the last thing with tariffs, they can increase pricing, which would eventually raise up our building cost, which is going to be more expensive for us, more expensive for our client buyers. So those are the three things that I'm seeing right now. The stock market crashing causes that fear and uncertainty that could also raise unemployment. And also, with that consumer sentiment going away, that's going to be an issue, while at the same time building costs are going up.
Yeah. I mean, people saw a lot of money wiped out of their IRAs. So, if you're concerned that, hey, there might be a blip in the market, and and your nest egg also went down at the same time, and you're concerned about what the future might hold for your job. Yeah, I mean, I could see the consumer sentiment getting dinged a little bit.
Sure. But I think, as you know, I lost the coin flip. I think there's some positives here too, and so do you.
Yeah.
So,
well, I mean, I guess it all depends on where you are, in the real estate world and in the real estate market in general, and where you are in your life cycle. I think when these sort of inflationary events, tariffs arguably could be inflationary. We all have some recent history with that. What happens, coming out of COVID. When we saw some rapid inflation, as a landlord and a property owner, rapid inflation is not really a bad thing for us as investors. Our income goes up, as rental rates go up, but you also see property values go up, with inflation. So, if we own assets now that were built, using today's dollars, and if the next house out that's built is built based on inflated tariff pricing, then then if you own property, that's not such a terrible thing. I think unemployment. If we saw heavy unemployment, I think that would be pretty negative for the rental market. But if it just holds steady at negative consumer sentiment, where maybe people, like you said, aren't wanting to make a big life change. So maybe they don't want to go buy a house and go on the hook for a long-term mortgage, when they're concerned, hey, I just lost, a big chunk of my, my IRA, my IRA is down due to the stock market going down. And, whether or not, they know of a reduction in force at their employer, could be on back of people's mind because the news keeps talking about it. So, a lot of those things drive people to rent versus buy. And I think, again, as real estate owners, where are we at in the cycle? I think it's important to mention where are we at in the inventory and leasing cycle. For the last year, Jim and I have been talking about how inventories on the rental side of things have been up, which has given us slower absorptions and less rental growth. And we have been predicting for a while that we would see the end of this big glut of inventory in February or March of this year, and we're actually starting to see that. Some of this I can't really tell what is reduction in inventory on the market for lease, and what is this consumer sentiment causing more people to rent versus buy. But for the first quarter of this year, we've seen a 50% increase in the number of units rented every month than we did last year at the same time. So, these are, pretty staggering numbers. It was like the switch turned on in January, and we saw some real gains in our absorption, which I believe by the end of the year, that's going to have some positive growth on rental rates in general. So, go ahead, Jim.
No, I was going to say, I think that's one of the biggest hidden benefits that I learned from, just the last week of getting our numbers in. The absorption of rental demand to go up 50% from just last year, from Q1 of 24 to Q1 of this year, for that to be up 50%, and that again is this quarter when the tariff conversation really started. That first week of January, we hit the ground running about what is this going to do? Are they really going to do it? So that's very interesting to see that demand has actually doubled, not doubled, but gone up 50% in just a year, which we weren't expecting to happen, I don't think, that early.
Right. No. Yeah, it's happening quicker than we thought, and it's certainly happening at a faster pace than we thought. Yeah, I think one of the other positive things that we've all seen is the 10-year Treasury has started to come down, which is the benchmark that most lenders utilize, and certainly the lenders that we are recommending to our clients when we're giving our incentive financing. All of that is based on that 10-year Treasury. So so that's making the cost of financing come down here. Again, pretty drastically. And and I think to your point, I think you said this before the video, Jim, that the Fed might have some additional effect on that.
They have a history in. You go back, and again, I've been started the real estate in '99, and my first experience with this was 9/11. In 9/11, when 9/11 hit, we all remember what a tragic time that was. There was a huge sinking of the markets right away, and interest rates began to drop drastically to try to stabilize the markets. And that's what the Fed does in trying times. There's been a couple of times we've seen them do that over the last 25 years, one of them being the beginning of COVID, when the rates were brought significantly down to try to do that. So with the tariffs, there has been talk that we've all heard that the Fed is going to. At first, they were supposed to be up 4 to 6 drops, and then it went down to about 1 to 2. But in moments like this, where they can't see this strong reaction of the tariffs or something of this caliber, they have been known to have emergency meetings. I'm not promising this, but I've seen it 3 or 4 times now in the last 25 years, emergency meetings, and it's a very bold move. It's not some quiet quarter point. They'll do a full point drop in one emergency meeting. So not sure that's going to happen, Chris, but I have seen it in my last 25 plus years occur. So that's something obviously that would bring some benefits to the 10-year Treasury most likely, and to our real estate investors as well.
Yeah. So just to summarize mine, I think the positives are we could see increase in rental demand even if there is a decrease in consumer sentiment. I think we're going to see decreased interest rates, which is whether or not you own property or you're buying property, refinancing to a lower rate or getting a lower rate up front, is obviously great for any real estate investor. And just the general inflation hedge of real estate. As these prices go up and you're sitting here with a fixed mortgage and rents are going up and values are going up, it just puts you in a much better position long term. Which is these stock market events like this are, again, why, are great reminders as to why it's great to have real estate be a portion of any investment, any investment portfolio.
Yeah. So we will be talking more about tariffs. My prediction is the word will not be used as much as it is in the beginning of this year for the end of this year. That's just my prediction. But we'll be bringing you more news on that, and we appreciate you joining us today. We'll talk again soon. Take
Thanks,
care.
everybody.